Let me ask you something. If someone handed you a map, a real map that showed every single trap, every single mistake, every single moment where crypto investors lost everything, would you follow it? Because I've spent the last 10 years doing exactly that. Watching, documenting, studying over 1,000 real crypto investors, beginners, veterans, people who turned $1,000 into $1 million, and people who turned $1 million back into zero. And what I found will genuinely change the way you think about this market. This isn't theory. This isn't some white paper. This is pattern recognition built from a decade of watching human beings interact with the most volatile, most emotional, most psychologically demanding financial market ever created. Because here's the truth nobody wants to say out loud. Most people who lose in crypto don't lose because of bad luck. They lose because of very specific, very predictable, very human mistakes. Mistakes that show up over and over again in bull markets, in bear markets, in every cycle, with Bitcoin, with altcoins, with DeFi, with NFTs. The asset changes, the mistake doesn't. So today, I'm breaking down the 5 things that destroyed the majority of those 1,000 investors I studied. And if even one of these hits close to home, pay attention. Because this video might be the most important 10 minutes you spend in crypto this year. Let's get into it.
Number 1, they bought the story, not the asset. I want you to think back to 2021. Everywhere you looked, there was a new coin, a new protocol, a new token promising to revolutionize something. Gaming, real estate, healthcare, supply chains, you name it, there was a blockchain for it. And people bought in hard. Not because they understood the technology, not because they'd read the white paper, not because they'd stress-tested the tokenomics or checked the team's track record. They bought in because someone told them a story, a compelling, emotionally charged story about the future, about disruption, about getting rich before everyone else figured it out. Out of the 1,000 investors I studied, over 60% of the ones who suffered catastrophic losses of 70% or more, had one thing in common. They could not explain, in plain language, what the project they invested in actually did. They knew the narrative, they didn't know the asset. This is different from investing in Bitcoin or Ethereum, where even a surface-level understanding of what those networks do gives you a foundation. I'm talking about the wave of projects that lived and died entirely on hype cycles, coins that had billion-dollar market caps and no working product. The story is not the investment. The story is the marketing. Before you put a single dollar into any crypto project, ask yourself, can I explain what this does in 2 sentences? Can I explain how it generates value? If the answer is no, if all you can say is it's gonna be huge, you're not investing. You're gambling on someone else's narrative.
Number 2, they confused a bull market for skill. This one is painful, and I say that with respect because I've seen it destroy genuinely intelligent people. When Bitcoin ran from $10,000 to $69,000, a lot of people looked like geniuses. When Ethereum went from 400 to 4,000, everyone who held it felt unstoppable. When altcoins were doing 10, 20, 50x in a matter of months, it felt like skill. It wasn't skill. It was a rising tide. And the brutal reality of crypto is this: a rising tide lifts all boats. But when the tide goes out, and it always goes out, only the people who actually knew how to survive. Of the investors I tracked, the ones who got hurt the worst in the 2022 bear market were almost always the ones who'd made the most money in 2021 and hadn't questioned why. They took the gains as confirmation that their strategy was correct. They scaled up their positions. They took on leverage. Some of them borrowed against their crypto to buy more crypto because they believed they'd figured something out. They hadn't figured anything out. The market had just been in an extraordinary bull run, and they'd been standing in the right place at the right time.
There is nothing more dangerous in this space than confusing luck with competence. Because when you believe you have an edge you don't actually have, you make larger and larger bets, right up until the moment the market reminds you what you're actually dealing with. The investors who survived every cycle I studied, every single bear market, every crash, every black swan, were the ones who stayed humble during the highs, who kept asking themselves, am I making money because I'm right or because everything is going up? That question will save your portfolio.
Number 3, they let emotion manage their position sizing. Here's a scenario. It's March 2020. Bitcoin just dropped 50% in 24 hours. The global pandemic is in full swing. Every crypto group, every Discord, every Twitter feed is full of people saying it's over. Crypto is dead. Sell everything. What did most people do? They sold. At the bottom. Into maximum fear. And then 6 months later, when Bitcoin was recovering, when it was climbing back through 10,000, 12,000, 15,000, those same people bought back in, bigger than before, into maximum greed. They sold low and bought high. Not because they were irrational people, but because they let emotion drive decisions that should have been driven by logic and a preset plan. This is probably the single most common pattern I observed across the entire dataset. Not just in 2020, in 2018, in 2022, every major correction, the same story. People who had perfectly sound long-term thinking completely abandoned it the moment the red candles came. And the flip side is just as destructive, the euphoria side. The moment when everything is great, when you're up 300% and a friend messages you about a new altcoin that's already up 1,000% in 2 weeks. And instead of sticking to your plan, you throw $10,000 at it because it feels like free money. Emotion doesn't just affect your buy and sell decisions, it infects your position sizing. It turns a reasonable 5% portfolio allocation into a panic-driven 50% bet. And that's where portfolios go to die. The investors in my study who consistently came out ahead had one habit in common. They made their rules before the market moved, not during it. They decided in advance, this is my entry, this is my exit, this is the maximum I will allocate to any single asset. And then they stuck to it. Not because they were emotionless robots, but because they understood that in crypto, the most expensive thing you can do is make decisions while the market has its hands around your throat. Number 4, they chased yield without understanding risk. DeFi changed everything. Decentralized finance gave ordinary people access to financial tools that previously only existed for institutions. Liquidity pools, yield farming, staking protocols, lending platforms, all of it accessible from your wallet with no middleman. And for a while, the numbers were extraordinary. Protocols offering 50% APY, 100%, some going even higher. People saw those numbers and heard one thing: free money. What they didn't hear, or didn't want to hear, was the full sentence: free money with risks you don't fully understand yet. I watched dozens of investors in my study chase yield into protocols they hadn't properly researched. They moved significant capital, sometimes their entire portfolio, into platforms offering unsustainable returns, without asking the fundamental question: where is this yield actually coming from? And then it came. The collapses, the exploits, the rug pulls, the algorithmic stablecoins that turned out to be anything but stable. Some of these events didn't just hurt the individual investors, they sent shockwaves through the entire market. DeFi is real. Blockchain-based finance is real. The yields can be real. But every yield in this space comes with a corresponding risk profile: smart contract risk, liquidity risk, token inflation risk, counterparty risk. And most of the people chasing those numbers had no framework for evaluating any of it. The survivors, the investors who used DeFi and came out ahead, treated every protocol like a business they were evaluating before investing. They asked, is this audited? Who built this? What happens if the token price drops 50%? What's the unlock schedule? Is this yield coming from real economic activity or from inflating a governance token? Yield without understanding is just a more sophisticated way of getting wrecked.
Number 5,
They never had an exit strategy. This is the one that gets people because it's the mistake that happens at the best possible moment, when things are going incredibly well. A lot of investors I tracked turned real money into life-changing money during the 2021 bull run. We're not talking about small gains. We're talking about people who turned $5,000 into $200,000, $10,000 into seven figures. Real, extraordinary returns that could have permanently changed their financial life. Most of them didn't take profits. Not because they didn't know the market was high, not because they didn't sense something was overheated, but because they didn't have a plan for what to do when they won. They had a strategy for buying, they had no strategy for selling. And when the market turned, when Bitcoin fell from 69,000 back below 20,000, when ETH gave back 80%, when the altcoins they'd been holding went down 95%, those life-changing gains evaporated, sometimes completely. The psychological trap is this. When you're up 300%, selling feels like losing. It feels like you're leaving money on the table. It feels like you don't believe in the asset. So you hold and hold and hold, right through the correction and back down to where you started. The investors who converted paper gains into real outcomes, who bought houses, who paid off debt, who built actual financial security, they all had one thing in common. They had decided in advance what they would do at certain price levels. Not emotionally, not in real time, in advance, when they could think clearly. Take 30% off at 2x. Take another 30% at 5x. Let the rest ride. Whatever the plan was, the specific numbers didn't matter as much as the fact that there was a plan at all. The goal of investing is not to have the highest number in your portfolio. The goal is to convert that number into actual real-world impact on your life.
So here's what 10 years and 1,000 investors actually taught me. The crypto market is not primarily a technology problem. It's a psychology problem. The technology is extraordinary. Blockchain is real. Bitcoin is real. Decentralized finance is changing the architecture of the global financial system in ways most people still haven't processed. But none of that matters if you buy stories instead of assets, if you mistake a bull market for skill, if you let emotion override your plan, if you chase yield you don't understand, if you have no exit strategy when everything finally goes right. The people who survive this market long-term are not the smartest people. They're not the ones with the best alpha or the most insider knowledge. They're the ones who understand themselves well enough to build systems that protect them from their own worst impulses. That's the edge in crypto. Not the next hot altcoin, not the next DeFi protocol, not the next narrative. Self-awareness and a written plan. If this video made you think differently about how you're approaching this market, share it with someone who needs to hear it. And if you want more of this kind of breakdown, real observations, real patterns, no hype, subscribe. Because the next 10 years of crypto are going to be even more interesting than the last. And I want you to be on the right side of them.